If I was going to keep any real estate, I would keep stuff in the multifamily kind of apartment rental sector. And I wouldn't even keep that myself, but that's the one sector I would consider keeping. Everything else in real estate, this real estate does not usually bubble like this. It didn't even in the roaring 20s, but lending has been so free and exaggerated. Real estate will see the biggest downturn in history. Now, first of all, nobody expected in the last downturn, the average house went down 34% at the worst. And it took 6 years to do it from 2006 to 12. So longer slide, longer to come out, but down 34%. Just to go back to support and just to erase the gains, just in this last final bubble, not the previous bubble, we would have to see the average house go down 50%. That is the biggest thing that's going to hurt the everyday household. The everyday household doesn't own a hell of a lot of stocks, okay? And they're not even in Bitcoin. And if they do, there's probably their kids and, and they want the kids to learn a lesson anyway. So I'm most concerned about real estate because Bitcoin will come back and go higher, okay? Stocks will not. I think we're seeing highs we won't see in most stocks, and we're seeing highs in most real estate we will not see in our lifetimes for people like, say, over 40 or 50. I don't think we'll see in the U.S. because we're now going to start slowing like Japan and other developed countries have, that sort of thing. But Bitcoin will come back because it's the next big thing. So I don't want to hold Bitcoin because I actually have a target of 3,250 to 4,100 on Bitcoin, or at least 10 to 11. If it gets there, then I'll start buying, okay? If you look at a stock chart, it goes 1, 2, 3, 4, 5 peak. And then when it crashes, it goes just back to the 4-wave low before the 5 peak. That's all Bitcoin would be doing, to go all the way down to 3,250, just retesting the late 2018 bottom after the last peak from 69,000 crash. The last peak from 20,000 crash down to 3,250. All it's doing is testing the last major low. So if I was looking at a chart and didn't know what it was, and I didn't know it was crypto, and I didn't have any ideology, it can't go this low because of this and the cost of this. And I get these arguments all the time because I'm in crypto land. All the crypto people are moving to Puerto Rico to save tax capital gains in the future, okay? If I just saw the chart, it'd be a slam dunk. It's going back to the 4th wave low. That is 3,250. So what is an orgasm? Now I'm talking the male orgasm, okay? Male orgasm, you get excited, it goes up. It's extreme excitement. It's not just hum-de-dum and things are getting better, yo-de-do. It's excitement. And it gets so intense, it can't last. That's why bubbles have to burst. So that's what the orgasm does. When I lay that Masters and Johnson's independent from a different arena over any major bubble in history, it fits better than anything else. Now, what I bring up the female orgasm is females tend to have multiple orgasms. I don't even be 2, 3, 4, 5, whatever. But the typical, what Masters Johnson said, the average must be 3 orgasms. Well, you look at the 1987, the 2000, and 2021, 3 bubbles in a row. Well, now you got on a bigger picture, the female orgasm. So bubbles, I tell people, bubbles are, and I don't mean it's kind of, somewhat, maybe, they are exactly like financial they are exactly like orgasm. And it's just in a different arena. And if the model, when you put the Masters and Johnson's model, and they're not measuring stocks when they did this model, and it fits so well, it's kind of like, well, maybe, and it makes sense because bubbles are intense. And the thing about bubbles is people always they go up so much, so fast that even the people out of them eventually get drawn. I think Irvin Fisher in 1929 fought that bubble and finally got in at the last minute before it crashed. The bubbles draw everybody in, and then they go down. And then after they crash, people go, how could we miss this? How could we have been so stupid? It was a bubble, damn it. Succession of waves, 87, 2000, 2001. Those were 3 bubbles, each one getting 87. When 87 at that time, we'd never seen that big a surge in a short period of time, and a 40% crash in a couple of weeks. That had never happened before that, not even in the 1929 crash, okay? So that was a sign, if you'd have been awake, and I didn't get that back then. Oh my gosh, we're going into a bubble era. The baby boom is so strong. Inflation's falling from such high levels caused by the cost of the baby boomers getting in the workforce. That's why inflation was high in the 70s. It wasn't government deficits. We've had way bigger government deficits with inflation now. So all of that extreme thing caused this kind of orgasmic kind of scenario. And it turns out that this orgasm model from Masters and Johnson is the best corollary I can find to say this is what it looks like. So if something goes up that extreme, and that's what I say, everybody's hoping on a soft landing here. And this is when I'll quit my profession. If we can get through the next 2 years with a soft landing and the markets only go down 20 or 30% and nice and orderly, and we get inflation down to 0 to 2%, and we don't have any big crash and big failures of companies, then I'll say, you know what? We're in a new economy and I need to retire. Gold is also, again, this whole timeline is getting stretched because they're able to keep pushing this crash out. The whole thing is don't let Humpty Dumpty fall off the wall because he's going to crack and break. Okay, that's the whole Federal Reserve thing. They pumped up a big bubble. They didn't intend to. They were just trying to save us from the last bubble crash. Now they got this huge bubble and they can't let anything fall apart. Okay, so that's the whole game here, to keeping this thing together. Gold in the 2008 downturn and crash, which to me, I'm telling my subscribers, okay, that this next downturn is just 2008 recession, Great Recession times 1.5. 50% greater stock crash, 50% greater unemployment, all of that. It's just what the crisis needs to be to finish off and detox this whole greatest bubble in all of history, okay? So in that scenario, in 2008, gold held up in the early stages of 2008 and only crashed in the second 2 quarters, and then it crashed about 45% briefly and then went back up again. So gold was not the worst crash back then, but it did crash and went running to mommy when everything else. It was the last thing to crash, and I would see that happening here, that it's going to go up to 2022, maybe 2,300, not a lot higher here, but if everything else crashes later in the next year or two, what I'm saying, to substantial new lows, gold will follow. It proved in 2008 when things got really bad, it was not the safe haven. And what was proven to be the safe haven, but I don't know why I have to argue with Peter Schiff and people about this, the 10 and 30-year Treasury bonds went up 40 to 50% in late 2008 when everything, including gold, finally went down. It was the safe haven. And that's what I want to be sitting in. TLT, average 20-year Treasury bonds. And I'd rather, most people be better just to buy the 30-year. You're going to get 4.5% interest. And if things go bad, that will be the one thing that will damn near sure go up, because money's got to go somewhere. And that is the safe haven. And gold would be, if we had an inflation, if the government got so desperate that they printed so much money that it just became hyperinflation like Germany back in 23. But this is not even remotely that. But if they did that, then gold would be the answer. And that's what Peter Schiff and the gold bucks think. That's the last thing. I am not buying gold, but I'd rather hold gold than I would tech stocks here. Any circumstances default. Corporate bonds, especially the more risky, can default. It's default risk. A downturn only brings lower inflation or even deflation, and that alone brings down yields in bonds, okay? So bonds normally benefit from a downturn, but bonds that can default, like the corporate bonds can, and especially the high-risk corporate bonds, those will go down and did go down in 2008 because of default risk. What will not default, if the U.S. government, for all these years, 14, 15 years now, can print money without abandon to keep the economy from collapsing. They can print money to pay off their bond. They will not default on the interest or the maturity of these bonds, and that's why they're the ultimate safe haven. A lot of corporations, even good corporations, may have to default or miss some payments, and that brings the value of the bonds. We're the best house in a bad. Are we good? Are we in debt? Yes, but Japan's more in debt than us. Most of Europe's more in debt than us. All the other developed countries are, except for Australia. Okay, so the dollar and the U.S. Treasury bonds will be the safe haven. But I want the Treasury bonds because they're locking in low, interest rates for a longer period of time and will benefit more when safe haven interest rates go with deflation, while risky interest rates like corporate bonds look more at the default risk. The treasury bonds just see the deflation, which is the positive for bonds in a downturn. That's why treasury bonds are the one and really the only safe haven if we have a 2008 downturn times 1.5, so that it's even worse than that. The treasury bonds were the only thing that went up at the worst of that crisis. Again, here's the problem. The Fed already overstimulated when they didn't need to. COVID would have been a perfect excuse to let the economy grow a little slower and work off some of this excess. They already overstimulated and then over-tightened. That tightening, even if they start changing their policy today, that policy is going to take a year and a half to hit. And so a lot of this could still follow through. So they already laid the groundwork for a crash to start to develop that's hard to stop. So that's what I'm looking for. If we can see a crash, and hard to stop means it's got to go below that last low. If we can't break 10,088, then it's not that hard to stop. Okay. So I'm looking for that this wave already looks like it may be turning over to me. Bitcoin is leading it. That's my first sign. Bitcoin should lead this if it happens. It is so far. It's already dropped from 48 to 42 in a short period of time. It has to keep going. Okay. If that happens and if stocks start dropping sharply and then it breaks that last low in stocks in the first crash, then it's going to be hard to stop because people are going to finally say, well, we thought the Fed was in control, but they're not. And the truth is, there's not a Fed official or chairman in all of history that's ever had sex or run a business. Okay. Not a one. So these guys just know how to manipulate and print money, which these things, they don't understand the economy from my point of view.